All right, so today we're diving into the world of stock market investing, but with a bit of a twist. We're going to be decoding the insights of Ian Dunlap. You might know him as Red Panda.
Yeah.
She's a financial influencer, and he's got a unique style, to say the least. Our source material for this deep dive is a YouTube video. It's from InvestFest 24, which is an event that's aimed at empowering Black investors.
Yeah, what's interesting about Dunlap is that he doesn't just give you the typical like Wall Street spiel, you know? He blends practical trading strategies with this really powerful motivational message. And it's specifically targeted at the Black community.
Yeah, you can really feel that energy in the video. He's got the audience chanting, "I deserve to be wealthy." It's definitely different from your average finance seminar. So let's unpack this a bit. What exactly is Dunlap's get-rich philosophy?
Well, at its core, it's about financial empowerment and kind of reclaiming market share for the Black community. Dunlap believes that traditional financial advice has often kind of steered the Black community away from long-term investing, and he's really actively trying to challenge that whole narrative.
Okay, so that's a pretty bold statement. So how does he back that up? Does he offer any specific strategies to achieve this financial empowerment?
Yeah, he does. He actually gets into like the nitty-gritty of trading, talking about entry points, and he uses something called exponential moving averages, or EMAs. And here's where it gets interesting. He doesn't just use like 1 or 2 EMAs, he uses 8.
8. Why so many?
It's about getting a multi-dimensional view of the market's momentum. So by looking at different time frames, you know, from short-term to long-term, he's essentially trying to identify those sweet spots where the odds of a price move in his favor are higher. Think of it like using multiple lenses to get a clearer picture.
Okay, that's a cool analogy. I remember he was also talking about the 50% retracement strategy. How does that fit into the picture?
Yeah, so he sees that 50% retracement point as a sort of like a half-off sale for the day. It's where the price has pulled back halfway from its high, and he believes it can be a really good buying opportunity for long-term holding.
Interesting. He also mentioned this thing called point of control. What was that all about?
So think of that like the market's center of gravity. It's the price level where the most trading activity has occurred. And Dunlap uses this to try and anticipate where the market might be headed. He even claimed to have like predicted NVIDIA dropping to $91 using this concept, though you know whether that's consistently reliable is another question.
I see. So it's like a compass, but for market trends. Okay, so he's given us these entry points and strategies. But what about the mistakes that people make along the way? He has some pretty surprising ones on his list.
Definitely. One that stands out to me is setting too tight of a stop loss. So a stop loss is an order that automatically sells your stock if it drops to a certain price, so it limits your losses. But Dunlap argues that being too cautious with your stop loss can actually backfire.
How so?
He says you might get whipped out of a trade prematurely just because of normal market fluctuations. Imagine setting your stop loss like so close to your buy price that a small dip triggers the sale, and then the stock goes on to rally. You've just missed out on potential gains because you were too afraid of a small loss.
Okay, I get it. It's like being too quick to pull the plug on a relationship at the first sign of trouble. Sometimes you just need to ride out those temporary bumps to see the long-term potential.
Exactly. And speaking of relationships, Dunlap uses a rather unconventional analogy for another common mistake: not marrying your plan for 4 years.
Right, I remember that. That's a pretty bold statement. What's he getting at with that?
He's emphasizing the importance of long-term commitment to your investment strategy. So just like a marriage, he says, you need to stay faithful to your plan for at least 4 years, no matter the ups and downs.
But isn't that a bit rigid? What if your plan needs adjustments along the way? I mean, the market is constantly changing.
Yeah, that's a fair point. But Dunlap's underlying message is clear. Don't jump ship at the first sign of trouble, you know? Stick with your plan and give it time to work. Now, whether 4 years is the magic number, well, that's debatable.
Yeah, it certainly makes you think. And I remember him warning against thinking more information makes you rich.
Yeah.
What's his thinking there?
It's about avoiding information overload. He believes that too much data can lead to analysis paralysis. Instead, he advocates for just sticking to a simple, consistent plan, focusing on what matters most.
Okay, that's an interesting perspective.
Yeah.
So he's all about simplifying things and just tuning out the noise.
To a certain extent, yes. He believes in focusing on the core principles and not getting bogged down in the minutia.
Okay, this is starting to make sense. Now I'm really curious about his recession strategies because they seem to go against conventional wisdom. He actually recommends buying the best companies during a recession.
Yeah, he does. He calls it a hedge against market downturns. It might seem counterintuitive, but his logic is that while everyone else is like panicking and selling, you can scoop up shares of solid companies at a discount. He even throws out some names.
Okay.
Bo, we're not sure what company that is. Could be a typo. BTI, Apple, Microsoft, and NVIDIA.
So it's like buying those designer shoes you've been eyeing.
Yeah.
During a clearance sale.
Exactly. He believes that recessions, they create these rare opportunities to buy low and potentially sell high when the market eventually recovers.
I see. So he's playing the long game. He also ties this back to his 50% retracement strategy, right?
Exactly. He believes that during a recession, that 50% retracement point becomes even more significant as a potential buying opportunity for long-term investors.
Okay, so that's a pretty bold strategy. Now, I remember him getting into some pretty specific trading techniques. Talk about timing your trades. He had some interesting advice about trading in different market sessions, didn't he?
He did. Yeah, he breaks it down like this. The Asian session is best for beginners because it's less volatile. Then the London session is good for consistent profits, even if it means waking up early. And the American session is more for, like, the seasoned traders who can handle the higher volatility.
Interesting. He also mentioned this thing called RSI, the Relative Strength Index. Is that one of those secret weapons that traders use?
It's not exactly a secret weapon, but it is a technical indicator that measures momentum. Dunlap uses it. But he recommends tweaking the traditional settings.
Oh, how so?
He suggests using an RSI setting of 95/5 instead of the more common 70/30 or 80/20. He believes this just gives a more accurate reading of the market's momentum.
Okay, so it's like fine-tuning the instrument to get a clearer signal.
Precisely. He's all about getting the most accurate data to inform his trading decisions.
Now, another key takeaway that stuck with me was his idea of marrying your target. What was that all about?
It's about discipline and sticking to your predetermined price target. Even when the market gets like really chaotic, he's urging traders to not get swayed by short-term price fluctuations. It's about having that conviction in your analysis and not letting emotions dictate your decisions.
So it's like resisting the temptation to sell when things get bumpy.
Yeah.
And trusting that your initial analysis will eventually pay off.
Exactly. And to actually figure out how much to invest in each trade, he uses something called average true range.
Okay, so it's not just about finding the right entry points. It's also about managing risk.
Exactly. Average true range, or ATR, measures how much a stock's price typically fluctuates. So this helps Dunlap determine his trade size, essentially telling him how much he can afford to risk on a particular trade.
So a stock with a high ATR would mean a smaller trade size to manage potential losses.
That's the idea. He's all about balancing potential reward with calculated risk.
This is all great, but how does he actually read the market and decide when to buy or sell? Does he have like a magic crystal ball?
Well, not exactly a crystal ball, but he does have a systematic approach. He looks at a series of charts, starting with the monthly chart, then the weekly, daily, and finally the hourly chart.
And what is he looking for on those charts?
He's looking for what he calls 4 green lights. So if all 4 charts, month, week, day, and hour, show an upward trend, that's a signal to buy.
So it's like a traffic light system for the market. 4 green lights, you're good to go.
Precisely. He's looking for confirmation across multiple time frames before making a move.
Okay, so he's got his entry points, his risk management strategies, and his market reading techniques. What else is part of his approach?
One thing that sets him apart is his emphasis on institutional investing. He believes that big players, like BlackRock and Vanguard, essentially dictate market trends.
Yeah, I remember him calling BlackRock the law, saying they have so much influence. So what's his advice for everyday investors? Just follow what BlackRock does.
Not exactly following blindly, but he encourages paying attention to where these institutional investors are putting their money. He believes there's valuable information to be gleaned from their investment choices.
Okay, that's an interesting concept. It's like peeking into the playbook of the market's heavy hitters.
Exactly. And he also recommends checking out websites like AngelList and Y Combinator to identify up-and-coming companies that could potentially become like the next market leaders.
So he's looking for those hidden gems before they become mainstream.
Right. He's trying to stay ahead of the curve and spot trends early on.
This is all incredibly insightful. It seems like Dunlap has a really comprehensive approach.
Yeah, he does. But before we get too carried away, we need to take a step back and look at the other side of the coin, the potential pitfalls and critiques of his approach, you know?
Okay, so we've seen all the excitement, heard the promises, but I think it's time for like a reality check. Is it really as simple as Dunlap makes it sound?
Yeah, that's the million-dollar question, isn't it? I mean, while his motivational style is super infectious And his strategies seem pretty straightforward. We do need to approach this with a healthy dose of skepticism. Investing is rarely like black and white, and there are always risks involved.
Right. And one thing that kind of stands out to me is the potential for oversimplification. He makes these strategies sound almost foolproof, but the market is notoriously unpredictable.
Exactly. Take his 4 green lights rule, for example. Sounds easy enough. But relying solely on chart patterns can be dangerous. There are just countless other factors that influence stock prices, like economic data, geopolitical events, even just overall investor sentiment.
Yeah, I see what you mean. It's like trying to predict the weather based solely on the temperature. You're missing a whole lot of other variables.
Precisely. And let's talk about following someone else's picks blindly. Dunlap throws out names like Apple, Microsoft, NVIDIA. But those might not be the best investments for everyone.
Right. Just because a company is doing well overall doesn't mean it aligns with my personal financial goals. Or risk tolerance.
Exactly. Investment decisions, they should always be tailored to your individual circumstances. What works for one person might not work for another, and that goes for his advice about buying during recessions, too.
Right. It sounds counterintuitive, but is it always the right move? What if the recession drags on longer than expected?
Yeah, that's a valid concern. Recessions are unpredictable, and even the strongest companies can take a hit. Timing the market perfectly is nearly impossible, and even experienced investors get it wrong sometimes.
So buying the dip can be a smart strategy, but it's not without its risks.
Absolutely, and let's not forget about his focus on institutional investors, like BlackRock and Vanguard. While they undoubtedly wield significant influence, simply copying their moves might not be the smartest strategy.
Yeah, they have vastly different resources and investment objectives than individual investors.
Trying to keep up with the Joneses in this case could lead to some serious financial setbacks.
Precisely. It's like trying to fit into a suit. That's not tailored for you. It might look good on someone else.
Yeah.
But it's not going to be comfortable or functional in the long run.
Okay, so we've kind of highlighted some potential downsides, but to be fair, Dunlap's approach does have some merits.
Oh, absolutely. His passion for financial empowerment, especially within the Black community, is really commendable. He's encouraging people to take control of their finances and participate in the market, which is a very positive message.
And his emphasis on long-term investing, that whole marrying your plan for 4 years idea, aligns with traditional investment wisdom. Right. Patience and discipline are really crucial for success in the stock market. While his analogy might be a little unconventional, the underlying message is spot on.
Yeah. And I appreciate his point about not getting bogged down by information overload, sometimes simplifying things.
Yeah.
And focusing on a core strategy is the best approach.
I agree. It's about finding that balance between being informed and actually taking action. You don't want to get stuck in analysis paralysis, but you also don't want to be making impulsive decisions.
So where does this leave us? Is Dunlap's approach valuable or potentially misleading?
I think the key takeaway here is to be discerning. His strategies, they can be a good starting point, but it's really crucial to approach them with a critical eye. Don't just accept everything he says at face value. Do your own research. Understand the underlying concepts, and consider your personal risk tolerance before making any investment decisions.
Right. It's like taking a cooking class. You learn some basic techniques and recipes, but you still need to experiment and find what works best for your own taste and dietary needs.
Exactly. And don't be afraid to seek out different perspectives. There's no one-size-fits-all approach to investing. What works for Dunlap might not work for you.
And I'm curious, what are your thoughts on his motivational style?
Yeah.
Is it effective? Or does it come across as a bit too hype-driven?
It's definitely attention-grabbing, and his energy is definitely infectious. He clearly knows how to connect with his audience and create excitement around investing. But I think it's important to separate that emotional appeal from the substance of his message.
Right. We need to be wary of letting hype cloud our judgment, especially when it comes to our finances.
Exactly. It's important to remember that investing is a marathon, not a sprint. Sustainable wealth building requires patience, discipline, and a sound strategy. It's not about getting rich quick. It's about making smart, informed decisions that align with your long-term goals.
Okay, so that brings us to an important question. How can we actually apply what we've learned from Dunlap in a practical and responsible way?
Yeah, that's where it gets really interesting. Instead of just mimicking his specific picks or strategies, we can actually extract valuable principles from his approach and adapt them to our own investment styles.
Okay, so how do we do that? How do we take these high-energy ideas and turn them into something actionable?
Well, let's revisit his concept of the 50% retracement, for example. While it's not foolproof, it does highlight the importance of identifying potential buying opportunities when a stock's price pulls back from its recent highs.
So it's about looking for those moments when fear or just like temporary setbacks create a discount for savvy investors.
Exactly. And remember his emphasis on long-term investing. That's a principle that applies regardless of your chosen strategy. Time in the market is often more important than timing the market.
Yeah. So even if we don't marry our plan for 4 years literally, the underlying message of patience and discipline holds true.
Absolutely. And while blindly following BlackRock or Vanguard might not be wise, Dunlap's point about understanding institutional investing is valid.
Right. It's about being aware of the forces that drive the market.
Yeah.
And recognizing that these large institutions play a significant role.
Right. And his advice about profit margin, that's a fundamental metric that every investor should understand. It's a key indicator of a company's financial health and its ability to generate earnings.
So while Dunlap might not provide like a complete investment roadmap, his insights can be valuable if we extract the core principles and apply them thoughtfully.
Precisely. It's about taking what works, discarding what doesn't, and tailoring it to your own unique circumstances.
Okay, so this has been a really insightful discussion. But before we wrap up, let's shift gears one last time and look ahead to what's next.
Yeah, so Dunlap talks about websites like AngelList and Y Combinator for identifying promising startups. And this hints at a broader trend, the increasing accessibility of private market investing.
Yeah, it used to be that only wealthy individuals
and institutions could invest in startups. But platforms like AngelList are really opening up those opportunities to a wider range of investors. Exactly. And this raises an important question for you to consider. Could private market investing, with its potential for higher returns, but also higher risks, play a role in your overall portfolio?
That's definitely something to think about. It's a whole other world of investing, and it might be worth exploring further.
Absolutely. The investment landscape is constantly evolving, and it's really crucial to stay informed and adapt our strategies accordingly.
Well, I don't know about you, but this deep dive has definitely given me a lot to think about.
Me too. And I hope it sparks some curiosity for you as well. Remember, knowledge is power, especially when it comes to managing your finances.
So keep learning, keep asking questions, and never stop exploring new ideas. And on that note, let's move on to the final part of our deep dive, where we'll uncover one more intriguing thread from Dunlap's presentation. We'll be right back. All right, so welcome back to the final part of our deep dive into the world of Ian Dunlap, a.k.o. Red Panda. We've covered a lot of ground, from his motivational style to his practical strategies. But there's one more piece of the puzzle I think we need to kind of examine.
Right. Remember how Dunlap kept referencing the VIX, the so-called fear index, you know? There's more to it than just like those specific levels he mentioned, 65, 82, 155.
Yeah, those numbers definitely stuck with me. But I'm still not quite sure what to make of them. Like, what's the bigger picture here?
Well, his focus on the VIX hints at this broader investment philosophy known as contrarian investing. It's the idea of going against the crowd, buying when everyone else is selling, and selling when everyone else is buying.
So it's like zigging when everyone else is zagging. Sounds a bit risky, doesn't it?
It can be. Contrarian investing requires a strong stomach and a willingness to kind of challenge conventional wisdom, but there is a logic to it.
Okay, I'm intrigued. Tell me more.
So markets, they tend to overreact to both good and bad news. When fear takes over, prices can plummet, even if the underlying fundamentals of a company are still strong. Contrarian investors see these moments as opportunities.
So they're essentially betting that the market will eventually correct itself and that those undervalued companies will bounce back.
Exactly. They're looking for those diamonds in the rough, the hidden gems that everyone else is overlooking, because they're caught up in like the panic.
I see. So it's about capitalizing on those moments of irrationality when fear or greed kind of distort the market's perception of value.
Precisely. But here's the catch. Identifying true market overreactions is a skill that takes time and experience to develop. It's not as simple as just buying whatever's going down.
Right. You could end up buying a falling knife, as they say.
Exactly. Contrarian investing is not like a magic formula. It requires careful analysis, risk management, and a deep understanding of market psychology.
So it's not something to jump into lightly. But for those who are like intrigued by this idea, where can they learn more about this approach? Are there any resources that you recommend?
Yeah, there are definitely some like classic books on the subject. One that comes to mind is The Intelligent Investor by Benjamin Graham, often considered the Bible of value investing, which shares some principles with contrarianism.
And are there any real-world examples of successful contrarian investors, people who have actually made this strategy work?
Oh, absolutely. One of the most famous is Warren Buffett, often called the Oracle of Omaha. He's known for his long-term value-oriented approach, often buying undervalued companies that others have written off.
So it's kind of like Dunlap's advice about buying during recessions,
Yeah,
but on a much grander scale.
exactly. Buffett has a famous quote, "Be fearful when others are greedy, and greedy when others are fearful." That pretty much sums up the essence of contrarian investing.
It does. It's a good reminder that sometimes the best opportunities come when everyone else is heading for the exits.
Right. And that brings us back to Dunlap. While he might not be the next Warren Buffett, his emphasis on the VIX and his counterintuitive strategies offer a glimpse into this fascinating world of contrarian investing.
So as we wrap up this deep dive, what's like the key takeaway for our listener? What should they be thinking about after listening to all of this?
I think it's this. Dunlap's approach, with its unique blend of motivation and kind of unconventional strategies, it can be a really valuable springboard for exploring the world of investing. But it's crucial to approach his ideas with a critical mindset. Do your own research, and remember that there's no substitute for a solid understanding of market fundamentals and a long-term perspective.
And never be afraid to challenge conventional wisdom.
Yeah.
And explore different investment philosophies. Even those that seem counterintuitive at first, you never know what hidden gems you might uncover.
Well said. And remember, the journey of investing, it's an ongoing process of learning, adapting, and growing. Embrace the challenge, stay curious, and enjoy the ride.
That's great advice. And if this deep dive has sparked your curiosity and you're eager to explore a new topic, we encourage you to submit your own source material. For personalized knowledge exploration, we're always excited to embark on a new adventure with you. Until next time, happy investing.